jump into the formula, with everything we're going through today, we're going to try and keep it relatively high level. There's a lot more digging into the different things you can do. And you'll note that as we go through some areas, we'll reference that you may just need to, it's pretty specific based on a specific investment or different things that you'll want to go do a little bit more looking at your specific scenario. So with the formula, as a reminder, so most of the pieces of the formula are generally factor-based, meaning you're just going to apply a risk factor to either an asset or a premium number or a reserve amount. As we've noted, the factors generally don't vary by company, but there are some factors that are applied based on the volume of business or maybe the asset concentration. We'll dig into that a little bit more, but just be aware that the size of your company might impact some of those factors. So when they were creating these formulas, they ran ratios and scenarios to try and see what the factors they needed in order to make sure surplus was sufficient most of the time. So the underlying for most of these factors was that it resulted in sufficient surplus 95% of the time, which is not too bad. So as we go through the different factors, you'll see that they're labeled as C0, C1. That C in the naming convention stands for contingency. Just means, the risk that the company is exposed to. So a few things to be aware of that the formula doesn't account for. And as we go through these, you'll see it makes sense. It would be hard to put a numeric value to these. So some of them are management, the experience and integrity of a management team, how quickly the company can adapt, access to capital markets. If there was some significant fluctuation or a catastrophic risk event, how quickly could they get additional capital in? The adequacy of your reserves, future business plans, as well as just overall policyholder and shareholder confidence in the company. So again, there's not going to be a number applied to these, but it makes sense that those do impact how a company would handle an event. So this is just a high level kind of explanation of how the formula works, and that, for lower risk items, you can see that the RBC factor is smaller, and for higher risk items, it's higher. So as we go through today, you'll hear me say a risk charge or a capital charge. So that's that far right column is the required capital. So we'll say, they applied the RBC factor, and this was the capital charge that is required in RBC. So just keep in mind, like I mentioned, lower risk assets are going to have lower RBC factors, higher risk will have higher. So we'll see that as we go through.